On Press Perspective today, we touch upon the impact of the US-Iran Memorandum of Understanding on stock markets here in this part of the world and on monetary policy decisions as well. Do stay with us. Hello and welcome to Thursday's edition of Press Perspective. It's June 18th here in Seoul. I'm Min Sun-hee. The South Korean stock market hit a fresh high of over 9,000 during trade on this Thursday amid a host of factors including chip makers, individual investors and even geopolitics. For more on the economic impact of the latest event on the geopolitical front, I have my colleague Celio Fioretti with French daily Croix here in the studio. Celio, it's great to have you here.
Glad to be here.
I also have Professor Yang Jun-sok at the Catholic University of Korea here in the studio. Professor Yang, it's been a very long time. Welcome back.
Happy to be here.
Right, Celio, we start with you. So global stock markets, including that here in South Korea, surged in response to news of a memorandum of understanding between the US and Iran, while global crude oil prices plunged. Let's start with the surge and the plunge.
Right, so financial markets reacted very enthusiastically to the report of a US-Iran peace framework. The biggest driver was the prospect of the Strait of Hormuz being reopened to trade. That's an absolutely critical waterway for international trade because roughly 20% of the world's oil normally transits through the Strait of Hormuz. As a result, as you mentioned, oil prices plunged sharply, falling by nearly 5% and moving back towards the $80 barrel range after having surged above $110 during the crisis earlier in the conflict. So investors interpreted this as a sign of maybe the major inflationary risk facing the global economy could ease in the coming months. And at the same time, as you mentioned, stock market, especially in Asia, rallied strongly all across Asia. In South Korea, the KOSPI jumped on Monday more than 5% and today reached the historical record of 9,000 points. In Japan also Nikkei surged almost 5% as well, reaching also an all-time high above 69,000 points for the first time ever. Wall Street also advanced with investors shifting back into riskier assets these days. That says there's still a lot of caution to have. The agreement is currently only a framework, so we'll see how it develops over time. Many details remain unresolved regarding Iran nuclear program, for example. Shipping companies have warned that it might still be too risky to cross the strait because there might be still some mines, so they will have to have a mine sweeping operation to really make it all safe. But it's going still in the right direction, so we'll see more development in the coming months.
Right. With regard to the situation here in South Korea, Professor Yang, despite the strength of the stock market, the local currency continues to be weak, prompting the US and South Korea to pledge cooperation to address the weak won. How do you explain this discrepancy?
Okay, well, it's really unusual to see a currency being weak when you have a trade surplus and a current account surplus. But what happens in Korea? Traditionally, what affected the Korean won, the Korean currency market, is two factors. The first is Korean exporters earning dollars abroad, bring it back to Korea and selling it in the domestic currency market. That has somewhat stopped in recent years. Korean companies are earning a lot of dollars, but they're not putting it in the domestic currency market. They're preferring it to keep it in dollars because they're afraid that if they sell the dollars now, they would have to buy it back later at a much worse exchange rate. So they're not putting their dollars into the currency market, so there's a relatively low level of dollar supply. And then the second traditional factor has been how much foreign money is coming into Korea's stock market or going out. And in the last month, there has been a large outflow of foreign investment from the Korean stock market. In May, about $32 billion on net flew out of the Korean KOSPI market. It was all made up It was all replaced by domestic investment, but still a lot of dollars left. So low supply of dollars, high demand for dollars. So that explains a substantial part of it. And then from last year, there's a new factor. Korean investors investing abroad. Usually in the United States, but not limited to the United States. And we were hoping that because KOSPI is doing so well and government has offered a tax break for money that's coming back, that we would see a lot of those investment in the United States coming back into Korea, changing those dollars into won. But apparently that has not been all that much successful. For May, only about $1 billion on net seems to came back. So that is another factor. And then there's a structural problem with the Korean currency market. Compared to the size of the Korean economy, the currency market is very small. So what you would think of as sort of a medium-sized transactions have oversized effect on Korean exchange rates. So that has been working against Korea in here as well. And I think because Korean won has been weakening for more than a year and a half now, there might now be a sort of a psychological expectation that Korean won will remain weak. That's going to take a shock to move that expectation and change it into a more stronger expectation. And I'm hoping that the cooperation with the U.S. May be the shock that can pull this off. But right now, it does seem like people have built up a psychological border, saying that Korean won will not strengthen anytime soon. So that's keeping the won from strengthening, I think, as well.
Right, unfortunately then. Celio, with regard to global oil prices, reports of its plunge have quite a number of people, including myself, asking, well, when will prices at the pumps begin to fall? What have pundits been saying about this?
Well, I have to warn you, at this stage, the consensus is that the consumer should not expect an immediate return to pre-war prices, even though oil markets have indeed reacted positively to this peace going on between US and Iran. We've already seen crude price fall significantly after the announcement because investors are betting that the Strait of Hormuz will gradually reopen. But experts caution that there's still a big difference between a diplomatic agreement and a full reopening and normalization of energy flows. And so still quite a number of obstacles remain. Hundreds of ships are still stranded and out of position. Insurance costs remain elevated. And some oil facilities and pipelines in the Gulf suffered heavy damage during the conflict. So all of this will take time to put back into a normal pace. In addition, security concerns, as I mentioned, including the possible presence of mines in the Strait, will probably delay any massive reopening and massive flows of ships through the Strait. And as a result, most analysts are projecting a gradual recovery. Capital Economics estimate that perhaps 80% of energy flow could resume by the end of the third quarter of the year. Other market specialists said it could take at least 2 months to really get back to the pre-war state, just to restore a safe and efficient navigation through the Strait. And also, so going back to normal could take almost a year in the end. The overall message is that also we've seen a similar pattern after the COVID. During COVID, we have seen a lot of inflation, and some companies got used to having high prices and consumers still buying, so they might not have too much incentive to lower their prices. It will take a lot of time, and economies all around the globe are also preparing for maybe a slow, gradual going back to normal.
Right, and staying with this, Professor Yang, what are your prospects with regard to a potential ease with regard to the current energy cost burden for South Korea?
Okay, well, Celio mentioned a lot of the most important factors. He mentioned that it'll take time to reopen the Strait. Also, it'll take time to restart production. Oil experts have said that just restarting production after it stopped will take about a month or two. And then a lot of the facilities were destroyed, production facilities. To repair those would take 6 months to 2 years. So these, even if the Hormuz is opened, the supply will be down compared to the pre-war period. And the pre-war period, actually, we had very inexpensive gas. It was in February, the price of barrel for oil was about $55 to $60. That's actually lower than the average oil price that we've seen in the 21st century. So when the supply is down, you wouldn't expect prices to go below average. And then there's an additional factor for gasoline and diesel fuel in Korea, and that's the price ceiling, wholesale price ceiling that the government has put in place. Now, this is still good for consumers, but it will just take more time for the prices to come down because right now the price of international oil is above what the price ceiling is. So for Korean consumers to feel the prices going down, the international price has to fall below the price ceiling. So Koreans are still paying less for gas than international prices, but still it'll take longer for a price on the Korean pumps to fall. You have to wait until that international price falls below the price ceiling. So it's going to take more time there as well. And then for other goods, manufactured goods, you have to remember goods are right now in the production process and then it'll go into the distribution process. But the goods that are being made now, they were produced using expensive oil, expensive intermediate goods. And that has to work itself through the system. You won't see manufactured good prices go down until they start buying cheap oil as raw material, and that works through the system as well. So it'll be quite a while before we see lower prices. I think month-to-month inflation will go down relatively quickly, maybe in about 2 or 3 months. But annual inflation will take maybe next year or more. Prices going down at the pumps, maybe at the end of the year, if you're maybe in the early or late fourth quarter. And then price level on the whole, maybe not, won't go down as much. Manufacturing prices, once it goes up, doesn't really tend to fall all that much. But if it does fall, it'll probably be, again, maybe about fourth quarter.
Right. I know what my Christmas wish is. All I want for Christmas this year are lower prices at the pumps. Against this backdrop, Celio, U.S. Federal Reserve held its first open market committee meeting under its new leadership, Kevin Warsh, back on Wednesday. Do tell us a bit about his rate decision and the reasons behind it.
Well, Kevin Warsh's first policy decision was, above all, a message of caution. The Federal Reserve kept its benchmark interest rate unchanged, maintaining it in the 3.5 to 3.75% rate, despite significant political pressure from President Donald Trump for lower rates. The main reason is that inflation remained stubbornly above the Fed's 2% target, while Warsh acknowledged that some of the recent price pressure from temporary supply shocks, partly in the energy sector, as we just mentioned, he made it very clear that restoring the price stability remains the Fed's top priority. But perhaps the most striking aspect of this first meeting was not the rate decision itself. It was Warsh's communication style. He dramatically shortened the Fed's policy statement and abandoned the kind of forward guidance market have grown accustomed to over the last 2 decades. In his word, he said, I cannot give you forward guidance about what we're going to do next. That represents a major philosophical shift even. Warsh appears to favor a return to a more traditional, less transparent Federal Reserve, closer to the era of former Chairman Alan Greenspan, where markets receive fewer hints and must rely more on economic data themselves. Interestingly, while rates were left unchanged this week, nearly half of the Fed policymakers now expect a rate hike by the end of next year because inflation forecasts have been revised upwards. So despite Trump's hope for rapid cuts, the Fed is more going cautiously, perhaps maybe even slightly more hawkish than investors were expecting.
Right. Right. Keeping in mind what Celio said, Professor Yang, what are your expectations with regard to the U.S. Federal Reserve's future policy direction under Mr. Walsh?
Okay, well, the data is telling the Fed to either hold the rates or raise it. I think very little of the data is saying lower the rates, but the problem is we don't know which way Kevin Walsh is going to jump. Now, Kevin Walsh, if you look at, say, what he said over the last 20 years or so, I think you can fairly classify him as a hawk. He wants more or less tighter monetary policy, but you also have to remember that he campaigned for the job of the Fed chairman with President Trump, and one way that he campaigned is that he said that he's very favorable toward rate cuts, and his justification was that use of AI in the economy will improve productivity so that prices, inflationary pressure will be reduced, so that allows an interest rate cut. I'm not sure if the financial market is completely convinced by that argument. But still, in some ways, you don't know whether he's a hawk or a dove. And we were hoping that he would give some indication today, but he didn't give very much. And because he's also against forward guidance, he's against the Fed saying too much, we weren't really able to get an idea on how he feels, whether the interest rate should go up or down. So he remains a mystery. And I think that will make monetary policy tougher. Now, there's good reason to not have forward guidance. It rarely has been right. But still, I think it does sort of give an indicator that is useful. But if the Fed decides to forego forward guidance from now on, I think I'm worried that it will make the market more confused, more mixed on how they think the future rates will go, and that will make monetary policy for other countries like Korea more difficult.
Right. So while the U.S. Federal Reserve has decided to keep its interest rate steady at 3.5 to 3.75%, Celio, neighboring Japan, it raised its interest rate to a 31-year high. Could you very briefly tell us about that?
Yes, it's a very significant moment for Japan because the Bank of Japan has raised its interest rate to 1%, the highest since 1995. Symbolically, it marks the end of an era in which Japan relied on ultra-low, near-zero interest rates to fight deflation and weak growth. For more than 2 decades, Japan struggled with stagnant prices and a sluggish economic activity, but the picture has changed. Policymakers now believe the country has entered what some economists call the inflationary upcycle. Inflation is no longer the exception. It has become a lasting feature of the Japanese economy, helped in part by higher global energy prices and rising inflation expectation. The Bank of Japan is therefore trying to normalize monetary policy. Officials are worried that inflation could overshoot their target in the medium term, even though headline inflation currently remains below the official 2% objective. So this is also a currency angle to this situation. It gets a bit more technical, but the Japanese yen has been under pressure for years, and higher interest rates can help support the currency by making it the yen-denominated asset more attractive to investors, even maybe foreign investors. And that said, the Bank of Japan is moving very cautiously in that path. Even after increases, Japan interest rate remains low compared to other major economies, such as the United States, for example. So this is not an aggressive tightening of the policy, but it's a gradual change of paradigm that Japan is facing now.
Right. And before we end today, Professor Yang, I'd like to circle back to something you mentioned earlier. Could you tell us a bit more about the broader implications of these rate decisions in the U.S. and Japan on South Korea?
Okay, well, taking to South Korea, EU has already raised its rates. Japan has raised its rates. Most, I think, major central banks do agree because the inflation has gone up that interest rate hike is necessary. Korea, I think, has a more clear case that it should raise the interest rates. U.S. is sort of delaying its interest rate increase, but Korea, I think, has a much clearer case to raise the interest rates as soon as possible. And that's that's because first, the stock market is doing too well. A lot of it is because of fundamentals, but still, you don't have a price rise like stock market rise like 200%, and you have to worry whether there's too much money, liquidity in the system. And then there's increasing household debt. Some of that money is being used to make not only bets on the stock market, but dangerous bets on the stock market. And then you have a weak Korean won. All of these, the textbook prescription is raising the interest rates. And then you have high inflation as well. The last CPI inflation was more than 3%. And you have growth rate readjustments. Korean growth rate is now thought to be somewhere between 2.5 to 2.7%. If it's on the higher end of that Korean economy, you could plausibly argue that it's overheating. And then the housing prices are creeping upwards as well. So all of these factors are saying raise the interest rates. Very few factors are saying keep the interest rate as is or lower it. So I think Korea has even a stronger case than these other countries for raising the interest rate at the next meeting.
All right, and we shall see if that is the case soon then. That was Professor Yang Jun-sok from the Catholic University of Korea. Thank you so much, Professor.
Thank you.
And Celio, thank you very much for your insights.
Thank you.
Right, that ends this edition of Press Perspective. As always, thank you for watching, and be sure to join us again tomorrow for more panel discussion.